Good morning and welcome to the Killik & Co market update. Looking through this week's market performance, indices are broadly flat across the board with a notable exception being Hong Kong. US markets are just over 1% of all-time highs, as are markets in Europe and Japan, and the FTSE 100 is now 11% from its all-time high set back in 2018, and the recent dip in the Hang Seng takes it further away from its all-time high, also set back in 2018. So I've included some measures of breadth here. Breadth is a measure of how many stocks in an index are participating in a market move. So this is calculated here as the percentage of index constituents trading above their average price over a rolling period of days. So for example, the 200-day moving average is a stock's average price over the past 200 days, and it's a basic measure of longer-term trend, which in this case accounts for around 10 months. So what we can say here is that breadth remains fairly strong in the US, with 74% of S&P 500 companies trading above their longer-term average. So for comparison, the 5-year average breadth for the S&P 500 is closer to 65% of companies above that measure. In currencies, sterling's a little weaker versus the dollar, and versus the euro is pretty flat. But one of the main stories this week has been in the energy market, so I'll touch on that in a little bit more detail. Energy demand's rebounding across the world as economies reopen and people return to offices. As you can see here, prices for gas and electricity have rallied pretty hard. Now, whilst demand is certainly playing its part, supply issues, particularly around gas, have led to depleted reserves, which leaves countries struggling to replenish stocks ahead of the winter heating season. Gas stockpiles in Europe, for example, are at their lowest levels in more than a decade for this time of year, which is pushing up the price of producing electricity. Europe's dependent on Russia and Norway for its gas supplies, and neither country has been able to deliver what's required. Here in the UK, next day electricity prices hit an all-time high of £400 per megawatt hour. And to put that into context, the average price over the past decade has been around £45 per megawatt hour. Prices have at least stabilised over the last couple of days. But in the UK, we're increasingly dependent on wind power to serve up energy to the grid. But a period of still weather and therefore lack of wind has curbed output. So at the same time, we've had 5 nuclear power plants have been offline, and our own gas terminals have seen waning inflows similar to those in Europe. So with a lack of wind, gas and nuclear energy, we've been left with little choice but to burn coal to make up some of the difference. So whilst the medium-term implications of a supply shock are unclear at this stage, it seems reasonable to expect higher energy prices to be passed on to consumers this winter. From an equity market perspective, some factories are already starting to curb output because of the increasing cost of energy makes their operations unprofitable. It'll be interesting to keep an eye on some of the more energy-intensive sectors and companies such as cement companies and car makers over the coming months. So some companies will hedge against higher energy prices, but others won't. It could be that we see profit margins being squeezed over the next few months, which could well hamper company earnings into the tail end of this year, but only time will tell. Apple were back in court last week for an anti-competition ruling. A software developer, Epic, who sell their products on Apple's iOS, accused Apple of acting as an illegal monopoly, engaging in anti-competition conduct by forcing customers to process all payments through the App Store. Now, District Judge Rogers ruled that Apple could no longer restrict developers from providing alternative payment mechanisms for in-app purchases. But while the judge signalled that Apple had been engaging in anti-competition conduct and that did need addressing, she didn't deem them an illegal monopoly. In fact, because Epic breached their contract implementing an alternative payment process, they were told to backpay Apple 30% of revenue collected during the period of implementation. So the ruling means that billions of dollars worth of transactions currently processed within the App Store are now up for competition with other payment providers. However, the case was only a partial win for developers, because Apple were not told that they should stop charging their 30% commission or fees. The back payment forced upon Epic could actually now open the door for Apple to demand percentage of profits from any in-app purchases on iOS, so whether processed through the App Store or not. Shares reacted negatively, falling 3% on the news, but beyond the ruling, investors turned their attention to Tuesday's launch event, where Apple announced a suite of new products, including the iPhone 13. They also announced that they'd be expanding their workout subscription service, which knocked the share prices of fitness-focused stocks such as Peloton. The launch event hasn't been enough to push the shares higher, though at this stage they're currently trading down around 4% since last Friday. Next week's fairly light on the corporate earnings front, but we'll be keeping an eye out for Accenture, Costco and Nike. That's all from us. Have a great weekend, and we'll be back again next week.